you can't ignore the pension situation any longer.
The income tax advantages are huge.
Inheritance tax is 40%.
I don't want that money going to the government in the same way as certain parts of my estate.
People can make the choices, but they can't make the choices if they haven't got the information in the first place.
Pension pots are typically not part of someone's estate when calculating inheritance tax.
What type of person do you think this will affect the most?
You could answer that and say it's everyone with a pension.
Hello and welcome to this episode of TV Lawyer. Today I'm going to be speaking about wealth planning in relation to inheritance tax and specifically in the light of the changes to pensions. I'm joined by Peter Ryan. Peter, would you like to introduce yourself?
Hi Melinda, thanks for having me. Peter Ryan, I'm the Director of Intellego Financial Planning and a Chartered Financial Planner. Hopefully we'll be able to answer a few questions you've got today.
I'm sure you will. So Peter, can you tell us a little bit about what you do and how you would explain that to someone who isn't very financial?
Yeah, okay. So financial planning is really trying to find out from people what they require from the best life they can possibly have and then look to structure their finances in a way that supports that. So it's trying to delve quite deep into what they consider a good life, which is sometimes quite hard to do for people because life typically gets in the way of thinking about things like that. So that questioning is quite deep sometimes. But once we understand what they want their life to look like, all the good things they want that to be about, we then structure their finances, try to create a plan for them. And we're trying to promote good financial habits, trying to look at the various financial products that are out there that can perhaps allow the planning to support that.
Yeah.
And then we put that plan into place.
So now, because of the changes to the pension rules, the advice that people will need, a lot more people will be captured by that. So what sort of people normally come to you?
It varies. The common theme, I would say, is it's people who want some clarity on what their future can look like. That's definitely the common theme. Historically, I've dealt with lots of business owners, but also clients who are employed in the more traditional sense. Yeah. So there is a variation of different clients from all age categories and stages of life and things like that. So it's not one particular group of clients, I would say. It does vary.
Is there a common thing about what people normally get wrong about what they think they need from financial advice?
Yeah, there is. There's not necessarily what they get wrong, but misconceptions, I suppose. A lot of people think that financial planning advice, you have to have lots of money, which is definitely not the case. And we deal with clients that, as I said, are different stages in life, but have come from different wealth backgrounds as well. But ultimately, a lot of them do just want that clarity and that peace of mind to have a roadmap for the future. Yeah. So, yeah.
I mean, I've been making wills and giving people inheritance tax advice, estate planning for many years, but I think that the current changes that are coming into effect in relation to pensions, probably one of the biggest changes that we've ever had to deal with. So there's been a lot of talk about it. Can you sum up what has actually changed?
Yes.
Thank you.
Very simply, as it stands today, currently, pension pots are typically not part of someone's estate when calculating inheritance tax.
Yeah.
And from April next year, which is when the changes come in, pensions will now be included in that calculation. And that's fundamentally the change.
So in broad terms, currently the inheritance tax nil rate band, as we call it, the basic level is 325,000, above which you may be your estate may be liable for inheritance tax. there's lots of potentially add-ons to that.
Yep.
And it can mean that it could be that your estate joint with your spouse is £1 million before inheritance tax is payable.
Correct, yeah.
And that's been like that for quite a few years now.
Yeah.
But obviously the pension pot, as you describe it, being brought in, will capture many more people.
Yeah, lots more people. And I think why it's become such big news, because it has been lots of information in the national press as well as the trade press as well, is because so many people have pensions.
Yes.
And potentially they're impacted by this. Some are going to be more impacted than others. Some might never have this problem being faced with. Their pension pot might not become an issue in the future because of the size of their overall estate. But I think because pensions are sort of entwined within the UK for retirement planning and things like that, this change has actually meant that people are thinking about this a lot more. And because inheritance tax is a big talking point within our country, the two hand in hand mean that it's received a lot of attention.
And what type of person do you think this will affect the most?
You could answer that and say it's everyone with a pension, which in theory that's correct. But I think there'll be lots of clients out there and lots of people out there who have saved in pensions for a lot of their life, but actually didn't perhaps think that they would need to draw from that, so had earmarked their pensions for their children, which is great. But now, because of the changes that were coming in April next year, it could be what they felt was going to be an amount that was going to be passed on to the children could be a lot lower.
Yes.
And I think you're going to find quite a big group of people who've looked at that situation and now think, well, I don't want that money going to the government in the same way as certain parts of my estate. What can I do now about that to plan effectively? Yeah.
So to maybe potentially use the pension or more of it than perhaps they weren't going to, because they thought, if I don't need to, that's a good way of gifting out of my estate tax-free.
Yeah, I mean, there's lots of different planning options available to people, and that's the beauty of financial planning in a way, is you can look at the situation and say, well, things have changed. What now can we do with this situation that will tick some of the boxes that we may have? But ultimately, some people might decide to spend that money. They may decide to take money from the pension and start gifting it while they're alive.
Yeah.
And some people will, bury their heads in the sand and not even know this is going on.
This is going on.
And perhaps be faced with quite a substantial inheritance tax bill at the end of it all.
And the other thing is that, as we've mentioned, the £1 million is the ultimate exemption level that some people may have. And tax is traditionally payable over that amount. Now, if pension funds come into that, more people will reach £1 million.
Yeah.
But then there's also the 2 million point cut-off.
Yeah.
And just for our listeners to explain that if your estate is between 1 million and 2 million, over 2 million, you actually lose some of the nil rate band allowance. So in fact,
you do.
Proportionately, you pay even more inheritance tax. So it really will be affecting people, because pension pots can be, what's the average value of a pension pot?
I think the average value is a lot lower than
we think it might be.
We think it might be, but it depends on who you're dealing with. You know, you've got some clients who've got really substantial pots.
Yes.
But you're right in what you say. The link between different types of allowances and inheritance tax and the loss of those, should your estate get to a certain level, really impacts on what kind of tax bill that could be paid in the future. So having that clarity and understanding what visually that could look like and being able to make different decisions around what you want to do is just vital, really.
It is vital. People can make the choices, but they can't make the choices if they haven't got the information in the first place.
No, they can't. And I think that's key to it, really, is trying to allow people enough information And it's a complicated area, so you have to be able to explain it in a way that people don't tend to glaze over too quickly. But if they're armed with
I am glazing. No, not really.
If they are armed with the information to be able to make that decision based on the information that's right for them, then they'll make good decisions rather than making decisions just because they're rushing or they haven't got all the information to hand.
So a question we often ask ourselves, and I wonder if you have the answer, what is the most common reason, do you think, that people put off planning?
Time, I would say. I think everyone wants to do this kind of stuff. There's so many important things that you want to do in your life, but life is very busy and those things get overtaken by the day-to-day pressures of life, I would say.
Yes.
So a lot of people have a real interest at initial conversations about getting planning in place, and that can be financial planning, can be planning from a legal perspective or a tax perspective. But it sometimes falls by the wayside because life just takes over. So I think time is perhaps the biggest obstacle that people face sometimes. But once you get past that and then you're engaged and you can see the benefits, it really becomes something that you get on with, you do, and you see the value in it. But I would say, time is the big one.
Yes, but it's time so well spent, isn't it? And you and I have worked together, and it's complementing professional advice, I think, is really so valuable because you know aspects of your work that I don't know, and vice versa. Yeah. And in our world, there are a lot of common mistakes that people make that they assume, and then actually when you drill down, in fact, it's based on a misunderstanding. And what's one of the most usual mistakes that people might make about pensions and savings, would you say?
Not necessarily mistakes, but misconceptions maybe.
Yeah, misconceptions, yes.
Yeah, and I think with pensions, what I've heard quite a few times during the last 20 years is, they're a waste of time. You don't get anything out of it at the end of the day. And that couldn't be further from the truth, really. I mean, if the tax advantage of pensions, setting aside the changes that are coming up with inheritance tax, the income tax advantages are huge.
Yeah.
And if you have a well-structured pension that is invested for the long term, it can make a real positive impact on the amount of income that you're going to have when you actually stop work. So that's one, people thinking they're a bit of a waste of time, which is not true. And from a savings perspective, and we see this quite a lot, is people holding far too much money in cash savings.
Yeah.
And we all do need some money set aside for emergencies and for comfort and things like that. But I think when you hold too much money in cash, what you tend to find is typically that value is going to be eroded by inflation over the course of time. And that's such a big risk. And sometimes that gets ignored by clients.
Yeah, and it's actually quite basic. I mean, we all moan year to year that the price of, I don't know, a pint of beer or something else has gone up. Yeah. And yet we don't realise that £10 in our savings buys us less each year.
Yeah.
And it could be invested and grow alongside the value of anything else.
Yeah, I think we're very aware of the risks with long-term investing in this country, and that's the ups and downs of financial markets, and that's spoken about quite a lot. But I think the risk of your money being eroded by inflation is not spoken about enough.
I know, yes.
And it's a very real risk, and it's inevitable ultimately.
Yeah.
So we see that quite a lot is far too much money in cash. And we talk about that and we have conversations about that.
Yeah. But I think the big message now is, isn't it, you can't ignore the pension situation any longer. From two perspectives, really, I suppose. The invest for your future, so you do have something to live on, but then the tax planning aspect of it now is huge. from a legal perspective, we're still not sure as to how it's going to work in terms of if you're the executor of someone's will and you have a duty to return the figures for the Inland Revenue on death and pay inheritance tax. One of the difficulties that is potentially facing those executors is that the pension fund is usually held completely separately by another bunch of professionals and who may or may not be responsible for paying that inheritance tax. We don't yet know because that is one of the fine parts of the legislation that isn't completed yet.
Yeah.
But the reality is that for ourselves and for those we leave behind, what we should be doing is looking now at getting pension advice and then combining that with estate planning and will making to ensure that everything works for the future.
Yeah. I think we as a company, we've always wanted that joined up approach with solicitors, tax advisors and financial planners looking at each component area of the bigger picture. And I think you run the risk if you just look at one thing in isolation of missing something really important.
Yeah, for sure.
With all these new rules that are coming into play, there's so much overlap in different areas. And I think if you try to do this one yourself, that's problematic. But if you only have one professional advisor, then there's that risk of missing something in another particular area. So, I think that joined up approach is vital.
And I think the other big message, if people aren't aware, is that inheritance tax is 40%.
Yeah.
So that's £400 in every £1,000 that you leave when you die would go to pay your taxes, which is a significant amount of money.
It's a huge amount, and we have been doing work for clients over the past couple of years once we were aware with these rule changes were coming in to show the impact of this. And it's huge when you see it in front of you visually. And, for some people, that money, going to the revenue is not what they want. They'd rather enjoy their life or be able to pass it on in a more efficient way. So,
one doesn't have to come at the expense of the other, of course, because with the correct advice, you can make gifts or plan in a way that suits everybody. I had somebody just the other day say to me, well, I'm going to put my home in my children's name to avoid inheritance tax, which of course is completely pointless.
Heard that a few times, haven't you? Yeah.
It's called a gift with a reservation, as you and I know. It won't save inheritance tax. And it's just such a shame because if that's done, it's achieved nothing except potentially risk your own ability to live in your own home.
Yeah.
Whereas there are all sorts of different ways that you can estate plan, aren't there?
Yeah, you can. I mean, there's typically a trade-off for whatever inheritance tax planning that you do. But I think you're right in what you say. If you can understand the situation of a client and what they're trying to achieve and explain those trade-offs, if you go down this route, this can mean that, but if you go down that route, that can mean that, then ultimately clients will look at that situation and just think, well, that really fits with what I'm trying to achieve here.
Yeah.
But trying to do it very quickly or too late is the problem. I think you need to look at this, and think about it a fair while ahead, just so you know what that structure can look like and what that can mean and what you need to do to engage in that.
Yeah, and because also perhaps it takes thinking about and weighing it all up. It's not something that you just do rashly.
I think that's key to it, actually, because the amount of clients that we have these conversations with, and the conversations that we have involve really quite big life decisions. And that's not something you can quickly make a decision on the back of a conversation with someone like you or me.
No.
You perhaps need to bring family into the conversations, and the conversations you have with your spouse or something like that will veer off in different directions. So it can take time, but after you've done all that, you usually come to a situation where you feel comfortable with what the planning could mean and what that can then involve.
Yes, that's so useful, Peter. And I hope that our conversation today has made you think or be aware of, should I say, the changes that are coming around, and that these types of conversations aren't necessarily scary or have to be dealt with in one go. They are gentle conversations, information gathering to understand exactly what the outcome would be for your own estate based on your current circumstances. Thank you so much, Peter.
That's great. Thanks for having me.
Pleasure.